Welcome back. This time I am with Ilya Kiliski. He's a managing director of Yaru Investments. And I would like to discuss with him some issues that are still not clear to me as they are presented by the media. First of all, we see different sources of uncertainty. And in the case of tariffs, you sent me a graphic created, an index created by Bloomberg. My question is, how is this index created? Because it doesn't seem to reflect expectations. You see, there is a declining trend, there is a peak, and then there is a decline that would not be consistent with expectations, considering that those that Trump himself said that he was just postponing the tariff. How is this indicator built?
Well, the methodology is itself is just how Bloomberg sees the uncertainty. It measures different macro inputs and puts it into one indicator that kind of reflects the measure of uncertainty on the market.
Does it
But the deal
use
is, yeah.
does it use service?
Also, it includes some consumer perception of what's going on in markets and so on. So once the tariff was introduced to markets, we've seen that the level of uncertainty increased. But the deal is that since the end of April, uncertainty went down, and this was one of the biggest drivers of the S&P 500 performance. We do see that currently markets are seriously growing without bearing any sort of risk. We see that the demand for hedging, for puts, is pretty low. We do see plenty of reflections where market sees pretty low level of risk.
Yeah, but that would reflect certain complacency. Wouldn't you
Yeah,
agree?
yeah, absolutely. I do believe that it's pretty synchronized. Let's say if we consider different markets, not only equities, let's say credit spreads, the ratio of value to growth, VIX index, different categories where we can measure the risk itself. We can say that everything is pretty synchronized. So from this perspective, let's say a growing equity market and narrowing credit spreads is just reflection of the same thing, just market complacency.
Yeah, well, and market complacency, my concern is that could trigger an overreaction if things are not don't go pinky dory as they believe they are going to go.
Yeah, it's purely a V-shaped rebound recovery where we had a, let's say, event-driven drawdown and then just the same buyout of everything that was sold recently. And we do see, let's say, S&P 500 reaching new highs, but the leadership is once again, it's super narrow. The same pro AI, pro leveraged names, large caps, etc. We noticed some sort of momentum sell-off happening last week and before, but it's kind of something in between understanding of that there is a decent chunk of complacency on the market. So some institutions have to do rebalancing on their end. But in fact, retail media just covering that everything goes fine.
Yeah, but it's beyond that because I could understand even in the Dow certain complacency because is sometimes is this they are moved by wings and whims and vibes, but the currency and treasury markets are supposed to be more cerebral, and they are also showing a high level of complacency, right?
Yes, yes, that's true. Like, interest rates and yield curve itself, it's a separate story because uh, let's say a few quarters before we've seen the yield curve spread the difference between the 2-year and 10-year uh, bonds or swaps go into the negative territory. So we noticed that it usually happens before yield curve goes up, slightly before recession happens. So it's super cyclical, and usually it's a reflection of some cyclical forces, let's say a business cycle. And currently we do see that yield curve goes up. It's slightly deteriorated from what is going on markets, but it's dangerously close to the levels where we've seen a recession in previous business cycles, and it's kind of one of the sources of risk that we consider.
And
Overall.
my other concern is that, for instance, what used to, there is, despite this gap, you can see in the series a high correlation between the 10-year treasury and the 30-year treasury, and yes,
Yeah.
now there is a gap that is explaining that is happening, it hasn't happened before. On the other hand, you see that graphic I sent you about this lack of correlation between the treasuries and the dollar index. That hasn't happened before. Even during the Biden years, was a gap, but the correlation stayed. And besides that, we don't have the tools because after a series of events during the Biden administration, you cannot trust the yield curve or the reverse yield curve because that didn't work. The sum rule because the market is still booming. The labor market is cooling down a bit, but it's still tight. So we don't have a compass, and we are going into uncharted territory. And at the same time, you see the the government, the federal government, that should be building a chest in case of emergencies, have no chest because his new bill has a strict spending to the bare minimum. So these are the things that concern me the most because we don't have we are going into uncharted waters, uh, and we don't have reliable tools. Is this correct?
Well, I can agree with that because the deal is that the synchronized dynamics of the, let's say, 10-year yield or whatever sits in the middle and dollar index was kind of reliable indicator of understanding of what's going on markets in the midterm. And that, let's say, gap between a dollar index dynamics and yield curve and let's say 10-year bond, it's just the reflection of more global forces. I think that we have to take into account that
But
geopolitics and
this correlation breaks just pretty much after Liberation Day.
yes,
It's
yes, that's true.
self-inflicted. It's more
Yeah,
self-inflicted than due to international to world forces.
yeah, absolutely. Like it's event driven, but now it's global because tariff politics, it's particularly domestic, particularly global. Obviously, consumers will pay at least 50-60% of
Hmm.
tariffs burden by themselves. And the
Mhm.
problem with the economy is that consumers are not that strong these days. We know that the level of savings is pretty low.
Yeah.
Households are weak, and people already started noticing that inflation can be driven by tariffs, so we can't ignore that. And Besant mentioned that probably in coming months we will see some sort of inflation spike.
Yeah, but before going into that, I wanted to finish with one more point about uncertainty. So, how do you react if you are a trade partner, if you see the president threatening tariffs on Mattel and Apple as if they were countries? That reflects a lack of understanding, leader surrounded by yes men that will cave to whatever whim the leader, the great leader says, right?
Well, that's true. We live in the world where some narrow leadership defines the policy, the market trends, and we've seen that before. Like, do you remember times when Elon Musk said something about Tesla, and Tesla was like a roller coaster going up and down? But we see the same story at a bigger scale on the country level, where the president defines what will happen on the markets. It's just super dependent on one person's activities. And let's say Liberation Day is a good example of that. We started tariffs and everything broke. Like the correlation between dollar index and yield curve, different metrics just broke just because one person started doing something. But it's kind of influential person.
And despite all, the market is complacent.
Yes, yes, it's certainly driven by some sort of optimism, but we've seen that before. Let's say just a few years ago, everyone was super optimistic, but at some point we've noticed a series of macro data coming out, and we noticed that recession is highly probable. So at some point, a market participant will understand that not everything is great with this economy. We see some cracks here and there, and we'll dig deeper into that later today.
There are huge vulnerabilities. We don't have uh, enough funds to back a fiscal response relief with the highest
Yes.
interest rate is going to stay high. And you can't control the whims of the president if he wants to continue his trade war with what he has already announced: copper, lumber, pharmaceuticals, and whatever comes next. Uh,
Yes, yes. Commodities-driven inflation is as dangerous as, let's say, inflation driven by tariffs, but it's interrelated, and we don't have enough resources to cover our needs. So if something goes completely off, probably consumers, households, and the whole economy will pay for it. Obviously, for us, will be pretty good to have lower interest rates and refinance the huge debt at a lower cost. But it's super dangerous to reduce the level of interest rates at current stage, because if inflation goes up, we will have to raise rates once again.
but in my understanding, it will all depend on how tight the labor market is.
Yes, that's I can say that two parameters, labor market itself and inflation rate, because we noticed that service inflation already started growing. So service inflation is usually a bit more sensitive, and we've seen that a few years ago, where before Fed started rate hike policy rally. So now service inflation goes up. If let's say goods inflation will go up as well, we will see more cyclical inflation unfold. And labor market is tight for sure, but yeah, it's questionable.
It's amazingly tight, despite all the forecast of the cooling down of the labor market. The labor market is still very tight, and that's a problem because the if the the labor market in 6 months stay tight and the tariffs start showing their effect on prices, that might lead to a mild stagflation. In the other,
Yes.
because Powell have already signaled that he is not going to cut interest rates if that happens. On the other hand, if the labor market is not tight, if it really cools down this time, is the most vulnerable who are going to absorb that 50-60% you mentioned before with
Yes,
diminished
that's true.
purchasing power. Mhm.
Yeah,
Now
and
that that that
that
that that brings me to precisely that the effects. I don't know if you have checked the charts of the Yale Lab, the effects on the per quintile, and precisely the losers are the most vulnerable, the poorest, the those small businesses that probably are still hiring while the larger companies has stopped have freeze new hirings, and also they are more vulnerable because they are instead of building a war chest, they are spending and believing that they are even more optimistic than the stock market, right?
yes, that's how it works, unfortunately, or I don't know. The deal is that a labor market is pretty complicated, and the biggest areas of growth were in the areas of, let's say, of jobs, which you can easy to get. And the difference between jobs, easy, hard to get and easy to get, just started growing.
Can you explain a bit
The
more the difference?
well, let's say less qualified job is much easier to get. So the biggest puzzle with labor market is that it's kind of tied to the immigration policy, because the biggest area of growth in the labor market was driven since COVID, was driven by less qualified workers. Most of them were kind of, let's say, from Latin America, from Mexico. Some of them are legal migrants, some of them are not, but they helped the economy to grow significantly. And with more aggressive immigration policy, there is a big chance that we're losing those people who can agree working for lower cost than average American. It means that we can easily, with more aggressive immigration policy, we can see let's say service inflation going up, and we can see that labor market will not be that strong that was before that.
And you have to add that to the effects of the tariff itself, because according to the Yale Lab calculations, agriculture and construction are going to be the most affected by tariffs. Add to that the effect of deportations, and then
Yes.
what happens if those effects are big enough to cause precisely bankruptcies or effect or disruptive effects so that prove to be too much for the companies, then you may have start a chain of effects on other sectors of the economy, right?
Yeah, the deal is that we already seen some grains and soft commodities prices going skyrocketing. We've seen some coffee prices, some grains. It's super fragile, and it can spike pretty fast. We've seen that recently. It means that market is ready to repeat that at some point if something goes off. With all those deportation and aggressive immigration policy, I think that agriculture sector is quite vulnerable. It's highly dependent on, let's say, cheap labor, on less qualified workers that hard to obtain if we have super aggressive immigration policy. And if we see food prices going up, we will see it everywhere. It just started with the crack. We've seen after, let's say, COVID, we've seen that commodities can significantly shift the shape of inflation for the whole country and even globally. And if it's supported by aggressive tariff policy, it just adds up to the source of risk.
Now, talking about vulnerabilities, we have the commercial real estate sector and the effect it can have on regional banks and on other even smaller banks that are not regulated by the Federal Reserve, because we have this problem that many have noticed that the regulation is fragmented. So, besides that, you have Secretary Vicente advocating for deregulating banks instead of trying to, because regulation should be an anchor in times of uncertainty. Well, he wants to cut the rope to that anchor and let the ship go.
Yeah, yeah. I can agree with that because there are some good numbers around it, and why it's structurally important for the economy because commercial real estate itself, it's a huge chunk of money. It's 1.5 trillion of commercial real estate debt matures in next year.
That
So
besides the asset-backed securities,
uh, it includes only commercial real estate, that purely
the
commercial.
loans. You
Yeah,
would have to add to that all those commercial backed securities that has been sold in
absolutely.
bonds.
Absolutely. And it has to be refinanced next year at higher rates. It's a huge pressure. As for the commercial mortgage-backed securities, the default rates are rising. We see around 7% in second quarter, 7% of default rate. And the second problem is that regional banks are the most exposed to that sort of risk there. Let's say 70% of all those loans are on the balance sheets of commercial real estate of the regional banks. So commercial real estate itself makes a huge pressure on regional banks.
And that's
And
another sector of over optimistic assumptions that they have just kicked out the debt down the road by refinancing the debt,
yeah,
expecting a fall on interest rate that is nowhere to be seen.
balance sheet of regional banks have quite bad mark to market. It just we know that all those numbers, mark to markets of all those loans and debt is pretty bad. At some point, market started ignoring that, but when SVB collapsed, uh, we just started looking more carefully on those numbers. Many sectors, not only commercial real estate, office, retail, multifamily, everything goes down. Prices just go down. In some areas, office real estate vacancy rates are above 20-30% in big cities like New York or San Francisco. It's quite dangerous. Let's say something is not working, 30% of something just is not working.
So to be frank, the most likely outcome is if this sector goes south, the Fed will have to show up and we will have to bail them out. Because if you get a bank run in times of uncertainty, that could end up who knows where. So we will have to bail out and this is small banks in case this happens, right?
Yes, GFC just taught us that banks should be saved uh, among the first sectors, because if banking sector goes down, we're just screwed.
In other words,
Problem,
sorry. In other
yeah,
words, in the times of Silicon Valley, we have some time, some margin of maneuver because the uncertainty was linked to inflation, but beyond that, the system was not didn't have these levels of uncertainty, and you didn't have reasons for an overreaction. So the Federal Reserve have more room, and the damage was limited to what, 3 banks. But in the current environment, it would be different, right?
Yeah, if it's one bank, it's just one story. It can be carefully tracked, it can be restructured or even sold. But if we see the same thing synchronized across different regions, different banks, it's much more dangerous. And we have to remember that the banking system, the Fed balance sheet is not the greatest these days. So to bail out the whole system, we need money, and we're desperately trying to find some extra money introducing tariffs. Let's not forget that a tariff policy is not just desire. It's not like I want to do something different. It's just one of the economic instruments that work in hard times. We know that we're running out of monetary and even fiscal instruments to maintain economy afloat. So the tariff policy is usually introduced when traditional instruments just can't deliver the desired result.
I wonder what
So,
would be the effect on the credit rating of the American debt if we end up issuing treasuries just to save banks.
well, it's already went down. I don't want to think of really bad things. Credit default swaps slightly tried to price out that, but not yet. We've seen some downgrades, and there is a chance it can go down once again if credit agencies will notice that US is not that stable to maintain that level of quality credit.
And as you mentioned before, the levels of savings, especially amongst those in the lower tranches of income, have practically disappeared. People are living paycheck to paycheck, and we have record levels of credit card debt, and the delinquencies have risen in the last years significantly. Not to mention
Yes.
that we also have in some regions, because in the case of housing, the housing market also showing signs of stress. Is this correct?
Yes, absolutely. On the consumer level, auto loan delinquencies are rising, credit card delinquencies are pretty high. And we have to remember that currently many credit cards offer, let's say, annual interest rates at around 30%. It's just hard to get out of that debt. And if someone already had a series of delinquencies, it means that it just a spillover, and it can be worse. On the corporate level, we do see the same story, because currently BBB rated, triple B rated bonds are making more than half of investment grade credit. So it's around 55% now. So one downgrade and it's no longer an investment grade. We do see that something that is called investment grade is almost leveled down than it's supposed to be. The bankruptcy level still more or less the same, but it's growing. It's gradually growing on the corporate level. So taking all those into one plate, we just see slightly worse story. And if we compare, let's say, mark to market on the credit level and equity market behavior, it just not equal at all.
And now
It seems like,
that
yeah,
you mentioned that, when it comes to investment, I guess the companies are basically investing in inventories. Nobody is full enough, especially those more exposed to trade, to invest in enhancing capacity, right?
Yes, at least for those sectors who can do that, because not all the sectors
Mm.
can allow are allowed to do that. Some companies try to play with buybacks or any other stories. What adds to the to rally is that some companies started issuing convertible bonds just to maintain the rally. Uh, so they try to spend extra cash they have on the balance sheet just maintaining what they have now.
But my concern was more directed to the product capacity, expanding plants production, long-term project. Those must be very low at this time because of uncertainty on tariffs, because of uncertainty about interest rates and the effects of fiscal policy. So I guess this is my guess, is that most of the investment businesses are making is in inventories, right?
They try to do that, and especially not only the companies that are related to the manufacturing or something from the real sectors. Even companies from growth sector, let's say data centers or something, even AI or semiconductors exposed. We live in the growth world, so if it stops growing, it just goes down. So even with this level of uncertainty, they still invest in new facilities, in new data centers, in new manufacturing facilities, or something that is related to building inventories tomorrow or even in the long term. It seems like market still tries to ignore the structural part and lives just today, looking
So
at what
so
we
there
have
have
today.
been so there have been no significant change in capacity investment.
Uh, it can be considered on the company level, but looking at that top down, I don't see any structural changes on that level.
So my other concern is the effects of, especially of the Trump's budget bill on productivity. You have cuts in science and research. You have cuts in healthcare that also affect productivity. And you have high level of uncertainty that also delay investment because you don't know what's going to happen. You don't want to put money on a losing horse. So,
Yeah.
and all this while in the foreseeable future, the interest rates are going to stay high. How do you see the productivity is there any how do you see investment in productivity despite all these factors that I have been mentioning?
Well, to evaluate that bill, probably it takes time to understand how it makes an impact on the whole economy and on a structural level, because we've seen Biden infrastructure bill before, and we can't say that it ended up like it started. So we've seen some projections who will be the beneficiary of those of that infrastructure bill, and we had some expectations, but in fact. It worked different way. So looking at this new bill, we consider that at the way that it can end differently than we see it today. And in terms of productivity, it will reshape, for sure, it will reshape some industries, but we can't predict it from today just without having enough inputs. It changes something, but not we can't predict that now.
But at least we can see that they are under the Trump administration has undermined some pillars on which you can build future productivity, right? Healthcare, research in science, and uncertain levels of uncertainty that precisely delay those investments. Could those not affect productivity? They will.
It will definitely affect productivity, especially in those sectors like healthcare, because if it's just not financed enough, it will just not work like it's supposed to work. And that's probably the crucial part about the bill. So if there is not enough financing on the government level and consequently on the corporate level, it will work a different way. But what we can't evaluate is the size of that impact. So it can be worse 30%, 40%, 10%. I think that structural forces and the whole economy dynamics will significantly impact on the stocks exposed to those sectors. So if complacency holds, probably it will be less impactful. If recession unfolds, I think market will try to price the whole recession instead of considering on the sector level. I think the broad rebalancing will be more driven by what we have currently today on the level of the whole country.
Another sector that occurs to me that it could be issuing red flags is the shadow banking, hedge funds that are regulated, and the Federal Reserve under Biden never came to come with a criteria to designate systemic risk in what cases this shadow bank represented systemic risks. And you see how intertwined these the shadow banking is to the regulated banks. Could this be another source of concern?
Well, it's always a source of concern because if something is not well regulated or if something tries to create a shadow alternative to the existing system, it's always a source of risk. We've seen many stories before when something tries to disrupt the industry or build the alternative to traditional industry, and it's always a source of risk. Let's say crypto. Crypto itself is under-regulated market that creates many opportunities for investors, but it comes at a certain risk. And the second part is
But crypto is not intertwined with the regulated bank
yes, that's true. That's
as the
true.
hedge funds are. And let's say the hedge funds decide that we have a let's say we have an overreaction in the case of the economy, and we need a relief to counter a recession. We need to issue debt, and then these hedge funds decide that we have become like an emerging market. So that the effect on the regular bank would be devastating, right? Because of how intertwined they are. Uh, and we don't have still a criteria. We are not going to have a criteria because Besant has already said that he wants to deregulate even more.
Yes, I'm not the guy who tries to evaluate why they did it, but the fact is, if we don't have certain criteria, means that everything can work, that everything that is not prohibited is allowed. And for those companies that can operate on that field, it's just a sort of opportunity, but the whole system is endangered.
And then you mentioned something that probably is not going to happen in a decade. Some people say less than that, that are the effects of artificial intelligence. because artificial intelligence, for instance, people like Paul Krugman are more optimistic, saying that, well, every time there has been some revolution in terms of technology, the new jobs have been created. But in this case, that is uncertainty. That is uncertain, and at least in the short term, those jobs are not going to be created. That could lead to, in a decade, especially in a decade where the federal government is not going to have a war chest unless they reverse Trump's policies. And you have lots of people that are going to get unemployed. And besides that, you have that the monetary policy is not going to work because you can reduce interest rates all you want. And in a case in which there is high unemployment due to artificial intelligence, that is not going to work because nobody is going to invest more in plants if there's no. So the only way you have to counter the negative effects of artificial intelligence is fiscal policy, which is precisely what has been reduced to minimum levels with Trump. So how do you see the effects of artificial intelligence, and in how long we could start feeling significant effects? Because we are already feeling effects, but not significant effects, right?
Yeah, it's just easy to break it down into parts and understand the real impact because it's easy to be criticized, but the deal is that artificial intelligence can disrupt the whole economy, some industries, it can reshape the labor market. But the problem is that what we have today is not the artificial intelligence. In
Mm.
most cases, it's large language models. It's just text models packed into software products. Most so-called artificial intelligence solutions are just large text models. It's just the whole internet packed into the model. And saying the whole internet, in most cases, the text internet. So I don't believe that artificial intelligence can mow your grass or do your dishes. So
So,
not
so
the
what?
whole.
So what sectors are? It's true. We have just software like ChatGPT, but that's just a very minimal, incipient level of artificial intelligence. So how is going to as this artificial intelligence evolves? How is that going to be felt in the labor market? To begin with, white collar jobs are going to be gone in its vast majority, right?
Yeah, of course, it's pretty important to separate technologies itself and artificial intelligence or large language models. Of course, some software solutions we see today, and they are just great. It's a great tool to simplify your workflow. It's easy to create a code. It's easy to write a text. Sometimes it's easy to do something else. But the deal is that technologies are developing broadly. It's not like everything is driven by AI. I know it's easy to put the label of AI onto everything, but R&D process existed before. And let's say agricultural sector. I think that computer vision, different sensors, different more efficient machines, they existed 5, 10 years ago, and it will be better and better in coming years. But we can say it's driven by AI. The hard labor can't be substituted or disrupted by AI itself because I'd prefer AI to do my dishes instead of writing a poem or music
Mm.
instead of me. So that's the second point. I think some industries, especially high tech, some IT industries, even R&D process itself will be much more simplified, driven by AI or any sort of models similar to that. It's just huge, big data, huge chunks of data models. They are super efficient in certain tasks. But I do
Just
believe,
no,
yeah.
go, go.
So I think the biggest beneficiaries will be definitely IT sectors. Everything will be improved thanks to the technologies, but I'd say broadly. And I don't believe that we need significantly less humans to do our jobs more efficiently. It's just a tool that can add 10, 20% gradually, decade after decade. But I don't see any significant jump. Let's say in 2 years, we'll need 10% less humanity to
But
operate at the same level.
let me process that, because if all white collar jobs, not all, but most of white collar jobs are gone, and then if you, as you mentioned, if you combine artificial intelligence with a process we already have, that is automation, that will affect blue collar jobs from agriculture to construction to everything else, then how could not that affect employment? Because not everybody. So you may still need supervisors, but all the rest of the people are going to be gone. That's going to affect the employment.
Of course, of course. On structural level, productivity improvement is something that reshapes economy. But the deal is that in some areas we will need less people. But technologies itself create new jobs, new industries, new approaches. For example, orchestrating all the systems, or even new categories of jobs will be created by technologies. So if something is more optimized tomorrow, let's say obsolete industries more optimized and more efficient today, it doesn't mean that we will not see new industries in the coming future. So from this perspective, I see it positively, as a positive impact on the whole economy.
In the aggregate, yes, it is positive, because it would not be tried if it would not increase the gross income of the GDP. The problem is that some people are going to be losers, and if you have a monetary policy that is going to have a much limited effect in these conditions, because you can lower the interest rate all you want, and the effects are going to be negligible. And if you have a fiscal policy that has been so watered down, the problem is that how are you going to compensate the losers of the revolution? Because if,
Well,
for instance, you say we need a minimum income, an assured minimum income, something like Andrew Yang suggested when he was running for president. Yes, but you cannot pay for that if you are not paying even for Medicaid, right?
yes, that's true. But in terms of productivity, I'm considering AI, large language models, as appearance of internet.
Mhm.
Obviously, it disrupted some categories or even industries, but we now we have tens more than we had before internet appearance. It will reshape the economy, it will change everything, but it doesn't mean that we no longer need the same humans to make our economy grow. It will be just different in decades, and we have to accept that.
That's the position of Paul Krugman. In my case, is that may be, or they might not be. In the future, in the long term, it will be. In the most near future, that may not be that much. And my concern is that we are, as I mentioned, that we are going to have to face that challenge with diminished power in the Federal Reserve to use interest rates and fiscal policy that has pretty much depleted the capacity of the federal government to raise revenue.
Yes, that's probably the outcome of living in the growth world. We like the long-term growth stories, like businesses uh, present their long-term growth stories to investors, but in fact, we have to face the rough reality with the economy, with the everydays, with the credit cards delinquencies, with the pressure on labor market, with debt refinancing, and it makes a significant impact on the nearest future of the stock market. Of course, all those growth stories are great, but what will happen in few quarters? What if inflation spikes? What if labor market will be not that resilient? So that's a question investors have to deal tomorrow.
And imagine that how the working class is going to face that future when they end up when they finish high school without many of them being in the capacity of reading understanding.
Let's say, let's say even tariffs are for pretty nearest future because they drive the difference between today and yesterday. It's the change in goods prices. It's the change of trade strategy of different countries, including the United States. Something's going on, and tariffs will make a significant impact on households' lives and, as a consequence, on the stock market itself.
Now, before finishing the interview and giving you the last word, something you mentioned triggered in me another question. This fiscal policy, excuse me, the trade policy in the Trump administration is supposedly aimed at reviving manufacturing and is supposedly inspired by the Plaza Accord from 1986 during the Reagan administration. But if you see the numbers of that time, it's true that the devaluation, depreciation of the dollar help stimulate exports, but not the manufacturing sector as a whole, and much less the labor participation in manufacturing that kept decreasing no matter what. Because tariff could be a way to stimulate production if it's part of an industrial policy. And precisely what the closest we have had to our industrial policy was what Biden tried with his infrastructure bill and the Inflation Reduction Act, which, by the way, Trump has has depleted in his fiscal bill because all those benefits that were in the Biden era are gone. So how do you have an idea? Some others say that no, this trade policy is not actually aimed at stimulating manufacturing, but at restructuring the U.S. debt with a Mar-a-Lago Accord. So they have conflicting objectives. Do you have an idea what may be the real objective, the real goal, or because it's based on fantasy and improvisation, it seems?
Yeah, well, maybe. I think it's slightly political, more political, and slightly beyond the common sense. Because if we consider it as is, it's definitely something that unfortunately impacts the industrial sector itself. I believe that reshoring is something that the United States really need because we import a lot of goods, and the whole tariff war is driven by the lack of industrial capacity in the United States. We have to import a lot of goods from the outside, and with all those geopolitical tensions, it became a big problem. Why it happens now, I can't say it's ruining forever, because we don't know what kind of bills we will see, or some laws or some changes we will see in coming years. I think it's slightly political to do things differently comparing to the previous government. And it looks like that, like we're trying to ruin something, but I do believe that White House understands that we need to start manufacturing stuff in the United States if we'd like to feel protected, and we would like to see onshoring activities, onshoring trends.
You have no, that's something that even came from the Biden administration, and I'm not a fan of the Biden economic policies. But one merit he has that it was that he made the American economy more resilient after what happened with COVID and the disruption of supply chains caused by China's clumsy management of the pandemic. The matter is that Trump's industrial policy is based pretty much on fantasy. It's based on a precedent that didn't provide what he said it was going to provide. It increased manufacturing exports by the whole sector, but the whole manufacturing sector kept declining. And on the other hand, you have, on the case of debt, on the contrary, this Mar-a-Lago Accord seems to be another fantasy that would lead even to a technical default of the debt, because that would, if it implies forcing countries to accept long-term bonds in exchange of the treasury bonds they have right now. So I am too severe and too biased, or is this reflects reality, unfortunately?
Well, we will see. I'm trying to evaluate markets from the economical point of view, so I'm not an expert in politics itself.
Mhm.
Uh, but we will definitely see. I know that economy is pretty fragile these days, and everything that adds to uncertainty is a huge source of risks for the economy. Every aggressive step towards changing something is can't guarantee that it's something super beneficial.
We know, with all its pros and cons, what Biden's industrial policy was. What's Trump's industrial policy besides tariffs?
I don't know it yet. We will definitely see it in coming quarters. No one knows, and
How do you
everything become.
how could you plan if you are an investor who interested in manufacturing? How can you plan if you don't know what the industrial policy is?
The deal is that even some commodities can be under tariffs, let's say tomorrow. We've seen some pretty complicated cases with steel industry, with something related to oil manufacturing, with all those Middle East tensions. So yeah, it's a tough time for the industrial sector, and probably not the best time for long-term investments in certain sector. That is why we see that sort of optimism spike, because it's a short-term optimism
But
driven by short
you
side.
may have optimism like Krugman about artificial intelligence, and you can have optimism based on fairy tales. You can see people in the Trump administration celebrating that we are decoupling from China. Bravo, bravo. That what they are doing is pretty much isolating the United States. And yes, you are going
Yeah,
to do the decoupling, but at the cost of isolating the United States, what implies a smaller economy with higher prices.
well, probably the deglobalization is the trend that we will face in coming years. Everyone becomes more isolated. It becomes more regional, more separated, and everyone tries
No,
to be
no, China,
dependent.
China is expanding on the global south. And if you in the future you need rare earth, you are going to a very hard time getting rare earth and magnets in other place other than China because you have isolated yourself, right?
Yeah, maybe. I'm trying to stay optimistic for the future of United States.
Now, after this barrage of questions, let me leave you the last word. What other issue do you believe it's important to bring to our attention?
Well, I think that we have to be careful with numbers. I think it's easy to stick to optimism driven by media, by, let's say, social media. But I think that numbers that we will see in coming quarters will be critical for the midterm and long-term vision. We have to track inflation. We have to track labor market. It's still actual, even though numbers are good these days, it doesn't mean
Mhm.
that it can change pretty quickly. It can unfold immediately. If we face a recession, it's driven by structural forces. It can be triggered by but we do see that structural forces uh, it can bring a recession pretty quickly. So stay protected. If it's a cheap hedge, just buy a cheap hedge. We have cheap puts, narrow credit spreads. We have a lot of opportunities. So stay balanced, stay wise, and track numbers.
And what structural forces we should care more about?
I think first of all, it's real estate market. Uh, we have to track credit cards delinquencies. We have to track commercial real estate. Everything that uh, reaches the certain threshold can be a source of opportunity and danger. So all those numbers put it into one place is a good set of indicators to track the future of economy.
Okay. Unless you have something else to add, I
Thank you.
believe
Thank you for today. I think good questions. Some of them are pretty tough, but we have to ask ourselves some tough questions to be aware what is going on.
yes, because without those answers, we cannot face uncertainty, especially when the traditional indicators like the reverse curve yield, the sum rule, and other criteria are seem no applicable or not longer valid. So we need a compass,
Yeah,
and if we don't have a compass, well, we need some
yeah,
answers.
yeah,
And
definitely.
so, Ilya, I hope we could meet again in a few weeks to see
Yeah,
how this thing is evolving, probably after August 1st, to see if
yeah.
Trump decides to be good on his promise of destroying the American economy with uh,
I
with all
crossing
these tariffs.
fingers for the best.
Mm, because so far he has announced so many trade deals, and it happens that the countries they are just memorandum of understanding that there are no deals. The China trade deal is really a truce. So we are in front of a minefield, and uh, well, but that will be for the next time. Thank you,
Yeah,
Ilya,
yeah. Thank you
and
for today. Thank
see
you.
you in a few weeks.
Yeah. Bye.